$4.75. That is exactly what a lukewarm coffee costs from the vending machine by the loading dock. You know this because you buy it every single night at 11:40, right before your shift starts at the bottling plant. The noise on the third shift is relentless. It never actually stops. It only changes pitch as you watch a blur of labels and seals move past you on the line. You are 23 years old, and you know the math of your own life without even trying. You trade your hours for $14 apiece. Every other Friday, after taxes, a check for $940 lands in your checking account. Rent takes a chunk, groceries take another, gas takes the rest. And in your savings account, there is exactly $612. It has been sitting there for 8 months, earning about 11 cents a month in interest. Then one night on break, a guy from the packaging line named Wes holds up his phone. He is grinning. He made $400 on a stock trade overnight. He talks about the money as if it had simply been waiting for him to notice it. You nod and go back to work, but something about that confidence sticks with you. You realize that your current equation, trading your physical energy for a flat hourly rate, has a hard ceiling. It requires you to keep moving indefinitely. You are exhausted by the idea of watching numbers sit completely still while you do all the heavy lifting. That morning, still in your work boots at 6 a.m., you open a brokerage account on your phone. You answer questions you barely comprehend about risk tolerance, picking the middle option every time. You set up an automatic transfer to pull $50 from your paycheck every 2 weeks, buying into an index fund with a name you can't even pronounce. You press confirm, and absolutely nothing happens. There are no fireworks on the screen. No one sends you a congratulatory message. Your bank account simply reads $50 lighter, moved into a place you can't easily touch without filling out a form and waiting. When you buy a truck or a new phone, the reward is immediate and visible. But taking the first step toward compounding wealth offers zero emotional feedback. You expect a beginning to feel like a beginning. This feels like nothing at all. 3 years pass. The noise on the line hasn't changed, and the coffee still costs exactly $4.75. But quietly in the background, your account isn't $300 anymore. Because you kept feeding it $50, then $75, then $100 every payday, the balance has grown to $11,200. One Tuesday, you notice a new line item, dividend received, $411. As those companies turn a profit, they slice off a piece and hand it right back to you as cash. You didn't assemble any bottles for that money. You didn't work a weekend for it. It arrived while you were sleeping, and when you let it be reinvested, it makes the total block slightly larger. That same month, Wes pulls into the plant parking lot in a brand new truck with gleaming chrome. Everyone in the break room talks about it. Later, you hear him quietly on the phone, mentioning that the new monthly payments are much higher than he expected, and he'll need to pick up extra weekend shifts at a hardware store to cover it. 2 very different machines have been set into motion. One requires taking on debt to display immediate status, demanding more physical labor to sustain it. The other operates completely out of sight, quietly generating cash that requires zero physical effort. But steady upward growth is rarely permanent. The market takes a sudden hit. By Wednesday, your account is down 8%. By the following week, it drops 14%. Looking at this chart, your balance falls from $31,000 down to $26,600. That is $4,400 gone. Your chest tightens. Your thumb hovers over the sell button to stop the bleeding. But you pause, remembering a half-forgotten rule. These are paper losses.
The money is only permanently gone if you realize the loss by clicking sell. So you put the phone back in your pocket and leave the shares alone. That night, your automatic transfer triggers exactly as scheduled. It doesn't read the daily news or check the market sentiment. It pulls $75 from your account and buys more shares at the newly discounted price. You start to realize that long-term investing has very little to do with outsmarting Wall Street. The math is straightforward. The actual test is whether your nervous system can sit still while the screen turns red. 10 years later, the supervisor calls you in. She offers you the line lead position. It means more authority and about $600 more a month after taxes. But it also means working weekends during peak season. You go home and check this math. On the left is the promotion, $600 a month for giving up your Saturdays. On the right is your portfolio.
Your automated engine paid out over $500 last month in passive dividends and interest. 10 years ago, you would have accepted the job before the supervisor finished her sentence. Today, you sit with those numbers. You return to the office and politely decline the promotion. You keep your weekends. The emotional calluses you built are soon tested on a much larger scale. Your account reaches $240,000, only to face a brutal market crash. In a single season, it drops to $198,000. $42,000 evaporates, the equivalent of 4 years of your starting factory salary. You don't sleep well that week, but you don't sell a single share. Accumulating capital doesn't immediately buy luxury cars or lavish vacations. Its true utility is creating a buffer between yourself and the demands of the world, uncovering the quiet ability to say no to labor you no longer want to do. By year 18, you find yourself sitting at your kitchen table late on a Thursday night, reviewing a simple spreadsheet. Looking at these trend lines, the math finally tips. Your grueling factory job paid you $62,000 for the year, but your investments, your dividends, interest, and realized gains generated $68,200. You sit back in your chair. The refrigerator hums in the background. A truck drives by outside. There is no parade, no music, no phone call from a financial advisor. The moment your money out-earns your physical labor sounds like absolutely nothing at all. Permanently replacing your income doesn't require a lottery win or a dramatic stroke of genius. It only requires a mathematical equation applied persistently over 2 decades of time. The following February, a sudden reorganization hits the plant. Shifts are slashed. Wes is cut to 3 days a week, and his heavy truck payments throw him into an immediate panic. Meanwhile, you stand in the exact same factory, completely insulated by a $600,000 safety net. You don't quit the plant. You've built a life around showing up to this job, and you aren't ready to let it go. But your psychological posture changes entirely. When you step onto the floor now, you are choosing to be there, not surviving because you have to be. On a Thursday evening, a 19-year-old coworker named Marisol asks you about her confusing retirement paperwork. You sit down and explain the math of the employer match, showing her what happens if she starts now versus waiting 5 years. You teach her the exact mechanics nobody taught you when you were her age. Right now, somewhere in a break room, there is an exhausted 23-year-old standing next to a coffee machine. They are staring at a banking app, hovering over the confirm button on a $50 transfer. 28 years of quiet compounding builds a massive account balance, but it also builds the discipline required to let the math work. This internal growth is the real asset, the one part of the story that never appeared on the spreadsheet.